if it does, we'll probably still have kind of a traditional form, just be kind of a new product. And there was no shortage of some entities that are trying to do that. The price reporting agencies already have their indices composed and they're out there marketing, and nobody's really using them because it's still kind of early in that development. So that's kind of a classic of the old way. But you have other things that go on. You have, in terms of, I mean, trading, it's people have the opportunity to trade more quickly. They have a variety of products. I think we've heard about some of them in a report, we had the presentation. And some of this stuff certainly, even if the use of some of it went down, I mean, if you go back a number of years, it wasn't used very much at all. So you have that out there in the marketplace too, and you'll have other combinations. And I think the integration between energy and environmental certainly hasn't happened yet, but it's but that could. I mean, in terms of how the products sort of come together. So I think there are new developments, whether they are the result of financial innovations that come more from parts of the market that serve those types of customers. I think some will. But even when that happens, I mean, I think a very successful one right now is the kind of volatility indexes and fixes and things like that. But if you ever looked at some of these volatility indices, you'd go, why did they choose that formula? And even in the Goldman Sachs Commodity Index, I mean, they can explain it to you, the people that worked on it. I mean, many of them are still around and would be happy to do that. But you realize there isn't, you got to make decisions. There's something arbitrary, not in a negative sense. I have to go this way or I go that way. And when I go this way, how much? So that type of thing's out there. But when you look at it, you realize, wow, this isn't just also fancy. It's designed to try to accommodate needs. And many of those needs are step-by-step developments. When you put all the steps together, it looks a little more complicated. But when you decompose them, it looks very sensible, and you say, wow, that was all very, very ordinary.
Yeah, I don't know that we have any brand new products per se. We have different permutations of old products, but I think two classes of market access that have sort of changed things were, 10 years ago, this advent of the investor products in commodities. So things like commodity indices, ETFs, structured notes, things like that, that gave a whole new class of people access to a market where access previously would have been much more difficult. And then this decade, clearing has sort of done the same thing. It used to be that most trading done in the oil world was under a bilateral credit agreement, which is a pretty high hurdle. Higher at some banks than others, but it doesn't give instant access to everyone in the way that clearing does by filling that requirement. So I think that has changed the nature of the market, even if people are still trading more or less the same old products. They're doing it in a different way.
I'm Yusuf Habib, and unlike Mike Lynch, I'm not even a pundit. This is for Catherine Spitler. If you would care to give your perspective on the following three things. Number one is what you mentioned about the post-2008 period as to the remarkable shifts that have occurred amongst various players. And I wanted to have your take looking forward as to what exactly do those shifts mean for you from your perspective going forward, number one. Number two, the fact that the global oil price, which is a Brent oil price, has remained within a remarkably narrow range over the last 3 years and now the fourth year going, say around $110, coupled with the fact that we right now have, I would say, almost a single-digit volatility in oil price. What does that kind of an environment mean going forward if it were to last for a while? And number three, again, your perspective going forward on the observation that the two biggest oil price benchmarks, Brent and TI, in terms of the physical oil itself, That's a very narrow stream in the 91 million barrel a day universe. Do you feel that there is going to be a need, an acute need for a truly good, better benchmark going forward? Or do you think that we've just muddled through as we have over the last decade or more with these two benchmarks with very low and even declining physical streams? Thank you.
Thank you for your questions. I'll start with the volatility one. I think that we are in a bit of a, I don't know if I should say death spiral, but as volatility gets lower and lower, liquidity gets lower. And as liquidity gets lower, volatility gets lower. I think you could also argue that there is a physical fundamental explanation for the reduced volatility, which is that there is this conventional wisdom that oil is now trapped in a bit of a band because of the increased speed of price elasticity of the type of tight oil production that's going on in the United States. So in other words, there's a widely held belief in the market that I would not necessarily disagree with, that if the WTI price fell sustainably below level X, and people will give you different numbers, 85, 80, 70, whatever it is, that there would be a fairly rapid production response to that, and that gives us a floor. There's also a widely held belief in the market that a Brent price above 120, which equates to a refined products price of, let's say, 150, something like that, is where we start to see demand destruction. So again, we can argue about whether this is a correct way of looking at things or not, but I do think that that is a widely held belief in the market, and that is a physical fundamental explanation for why we're seeing such low liquidity in oil, but really we're seeing low liquidity across many of the commodities. So that was true of natural gas as well until this winter. So I think that there is a market activity explanation there as well, and I think that there's that sort of feedback loop between liquidity and volatility, and they feed each other. In terms of how our business has changed, I work at CIBC, which is a Canadian bank, which I think is one of the market makers that has actually benefited from the revolving door over the last few years, because the CIBC, specifically the Canadian banks in general, have very high credit ratings, and that has become increasingly important to counterparties in the market since the financial crisis. So I think we've seen banks exit, certainly, but the banks that are left, we've also seen a bit of a rotation there. Many of the European banks have significantly reduced their activity. Many newer entrants are coming from either Asia, Canada, places like that. So that's been beneficial to our business in a sense, particularly I think in the institutional space, where many institutional investors like pension funds, for example, have written into their charter who they can deal with and how good their credit has to be. That said, I think it's become a much more challenging trading environment for everybody. And one challenge that many traders might bring up, for example, is the block trading reporting requirements. So as of the beginning of 2013, there's a rule that requires that block trades, large trades, have to be reported to the exchange and effectively hit the screen within 5 minutes of being done. Many traders would argue that this is now a more difficult risk management challenge, and that additional risk management challenge has to be reflected in the way that they price the business. So in other words, it used to be that if you took down a large trade, the trader would have some time to work it in the market. Now it hits the screen immediately, so everyone knows that that deal is done immediately. So that makes the risk management a different sort of challenge than it used to be. So I think that banks are still trying to figure out exactly what their role should be in the market. I think to some extent there's been a big move back to the producer hedging business because that has grown, and the hedge fund business has gotten more challenging. And then depending on which bank we're talking about, there is still some growth in the institutional space, although those flows have also started to slow. So I think probably, if I were to generalize and move back to core business, producer consumer hedging is probably the trend at the moment. I may have additional.
Yeah, I have one additional observation. We tend to think of our own business as being relatively unique, so we look at volatility in the oil and gas markets, and we forget about the rest of the world, but all asset classes have seen this exact same drop in volatility. And the puzzle is, why? And one explanation is the aftermath of the financial crisis and relatively low interest rates. And there is a hypothesis that when we get into a higher interest rate environment, there will be a return in volatility across all assets, not just the oil markets. I'd like to make one observation about Catherine's last observation on reporting requirements for large trades. Since we were involved in, I think, the largest trade in the market this year, and the market never knew it until well after. So you can be adept at managing it, provided you and the counterpart.
Some traders are more equipped to do that.
Yeah.
I did address the benchmarks question, and there may be some additional comments on that. I think everybody loves the idea of a new benchmark, but nobody sort of latches on to the practical requirements of that. And I think we've learned lessons from the NYMEX about how hard it is to even get people to shift in an orderly fashion to a new delivery spec on a refined product, let alone an entirely new crude. And then there are also a lot of practical considerations about the benchmarks we have now may be bad, but it's hard to necessarily pinpoint one that would be better and would fill all the requirements of volume, delivery infrastructure, a host government that is suitable for that kind of role. So I think that's why we sort of seem to stick with it as we know.
Catherine, I'd like to ask you a kind of question on new benchmarks, and maybe Bob can chime in. You've written probably more extensively than anybody else in the financial sector on the U.S. as a hub for LNG and the creation of a potential spot market for LNG based on where projected growth in the U.S. LNG business is. What are your thoughts about there being an LNG spot benchmark emerging maybe by the end of the decade? If you could chime in on that as well.
Yeah, that's a tough question. I think our trading business is North American gas, so that's my focus, and I tend to look at LNG in the context of how it will affect North America. So I can't claim any expertise on LNG pricing in Asia or things like that, but I do think two notable developments put a little bit of a chink in the armor of oil-linked LNG pricing. One is that there are now two long-term supply contracts signed for U.S. LNG export out of the U.S. Gulf on a Henry Hub basis. And the second is maybe, we'll get more details going forward, but the Russia-China gas deal, which seems to have been done at a price that's fairly attractive for China relative to what they pay now for LNG imports. So I don't know that we can call the death of oil-linked pricing quite yet, but there is some movement there that wasn't there a year or two ago. I think that different analysts will disagree on how much LNG volume will ultimately leave North America, and I think that there is a big first mover advantage there. So in other words, there's really no policy hurdle anymore in the U.S. anyway for LNG exports, and there will probably be far more projects approved than will ever actually get built. So who gets there first is very important, and I think that the way the long-term supply contracts are priced will be a variable in that race, so to speak, and one that probably puts the U.S. ahead of Canada, although I have to sugarcoat that when I go to Alberta. But it is, I think, a meaningful variable in the race that these two long-term supply contracts at Henry Hub have now been done.
Yeah. I mean, Ed, you gave us a very safe time frame. I mean, I'm trying to think, 2014, the end of the decade would be 2020, or 2019, I guess, at the end of that, at the beginning of 20. It would seem that a significant integration or greater integration of the U.S. natural gas market with the rest of the world may occur by then, but and who will remember that I actually said that today in that time period? say, boy, were you wrong. So I think there's a good possibility, yes. And that would be very exciting because I think it will still be the Henry Hub or a Gulf Coast, Louisiana benchmark. That's kind of the pivot point for North America and thus the world. There is a lot of liquidity built around that, and ignoring what could be self-serving on my part, since it's our product, but the fact that the natural gas industry on its own kind of developed all that pivoting around it. I mean, even in Alberta, the AECO is a lot traded basis, it's spread to the Gulf Coast, the price. I mean, you look at some of these relationships at times and you'd say, wow, that's really volatile, and why would they do that? But they do. And their business has developed around it, and they manage it well. And I think that's a credit to that industry. And I'm not surprised they did it, but that's why I think that it will still be a very important continuing benchmark. If I can make one comment, I'm not going to press it too much, but I think earlier somebody said something about running out of WTI. Whatever criticisms have been made about WTI, I think it was more the opposite. I think they had too much of it, and it's been growing. I think people, and even as far as Brent goes, I mean, they use BF, O, and E. If you follow that market, that's the crudes in here. They have 22 other letters, at least of the English alphabet, and there's other alphabets they can go on to. They are considering that, so that may be how they try to prepare for those.
If I could just throw out one sort of controversial, maybe thought on natural gas benchmarks. I do think that, I mean, Henry has a very strong benchmark, but I do think that going forward, particularly by 2018 or so, Dawn will become a very, very important North American gas benchmark as well.
Hi, my name is Peter Balish with the Department of Energy. I came in a little late, so I'm sorry if this question's been addressed, but you made a point about mean reversion to $100 a barrel, which is, if that's true, that's important for price forecasting. But I'm under the impression that the marginal cost of the next barrel well is somewhere around $80, $75 to $80. If you accept that, what explains that differential? Is it the market perception risk, or is there a role of quantitative easing and easy money propping up that differential?
To just qualify what I said a little bit, I think that chart alone suggests a mean reversion to $100. So if we base our decision purely on that data set, and that data set is still moving, so that third scatter plot on the chart, the pink one that shows the post-2009 period, is still a relatively small number of data points. And I think that we've had a lot of moving parts since 2009, both physically and financially in the market. So I would reserve judgment on where that intercept lands for at least another 5 years or so. I think that we may see that third scatter plot continue to move around a bit. But my point is, it certainly is never going to be an intercept of $20, I think. So we can argue about whether that intercept will ultimately be 80 or 100 or whatever other number we want to pick based on all of those other variables that we could look at to answer that question.
I appreciate, Dave, you identifying yourself with DOE, and I know the following may be one of those controversial sort of statements, the sort of thing that gets economists to say, let's step outside, I don't know, but it seems to me you're always, if you believe you're on supply and demand curves, because you might believe there's little dynamics there, maybe you're catching up, you're always operating on short-run curves. You might hit a long run over time, and that's fine, but you're always in the short run. And I haven't heard anybody argue yet that the short-run curve, demand curve for oil is anything but very inelastic. Maybe some people think it is. As I say, people can adjust over time, but then you're just operating on a new short-run curve. And we've been through a few of those cycles since the early 70s and even before that. And it's still very inelastic. So I would hope that DOE would consider the possibility, and in fact, the likelihood that if the price does shoot up, it's because the demand curve, and maybe there's a supply response for whatever reason, maybe they're not supplying the oil, in that time frame, but you're operating on a demand curve, and you're really still operating according to fundamentals. Nothing artificial, unless somebody's able somehow to keep supply out of the market. We consider that artificial. That's one of their decisions. But beyond that, you're operating on that curve, and the price can go high. And we've seen that. And we've seen it go low really quickly. Those are indications that you have a very heavily inelastic short-run demand curve. They're unambiguous indications of that. Other stuff, people can come up with their theories, but that one, and I've never seen anybody estimate it as anything other than that.
And my own observation on it is that if there is mean reversion, it's on the deferred price and priced by the market as whatever the market thinks or comes up with as a mean reverting price. The $21 mean reverting price up until 2002 held pretty well. Then there was incredible volatility on the deferred part of the curve, and by deferred I specifically mean 60 months out, which is kind of the planning horizon for big projects. And if you look at both WTI and Brent, yes, there is some convergence, not as much as there probably should be on the tail end of the curves, but they pretty much are where the marginal barrels will be priced. If you look at Canadian project as being a marginal project, that deferred price tells you a lot about what the market is pricing in reversion.
Yeah, that's fair. That's a subtlety of how you do the statistics. So for the purpose of what I did, I think I was using month 1 versus month 6. If you used month 1 versus month 24, you get different intercept. So yeah, that's a subtlety of just how I use the data.
Anybody else? If not, thank you both for starting this conversation, for the stimulation you've had for the bunch of people who've been here. Thank you.
Yeah. All right. Nice to meet you. You were the first one I considered that you came just newly hired by us. You did email me like 2 years ago.
I'm sorry, I'm coming back.
Okay, no, I just want to say hi. You're still the senior music? Oh, I heard you well. Yeah, we had to say that's right, yes. Okay, well, good. So I know I can still find you. So sort of at one point I just wanted to contact you. So I'll- F you, yeah. I just want to say, so I want to keep going for it.
Yeah, for your question.
Yeah.
I saw him yesterday. He just wanted to get his advice on what I should do with it.
Right.
And he did mention that there was strategic plan.
They were going on hiring spree for about a year and a half now. And you know Adib? So Adib was the predecessor of the guy after Yasser Mufti. When Yasser Mufti left, Adib assumed that position. And now I think he left just last month. But he's been hiring many people. So we would go to McKinsey, go to Sarah. These are, second tier. If we can get someone.
If you don't mind putting it in your notes, I assume that
You're not the commodities person, are you?
I'm a commodities
What do you-
person.
what do you do?
I'm the commodities person. Sorry, I'm not saying.
Oh, yeah, you were on the panel, right?
Yes.
Oh, I'm on your crew. And are you doing trade finance? Is that I missed.
No,
right
sorry,
over
I'm
here.
on the derivatives desk. I do the strategy on the derivatives desk.
You know the trade finance people?
Yes, I can figure out who they are if it depends on their sector.
Metals and
Yes, actually, we just hired someone to specifically focus on metals.
we do both. So it's like copper and distillate.
Okay, why don't we exchange cards, and I would be happy to put you in touch with the right people. I am not the right person, but I can put you in touch.
Can I just put just kind of write down like you'll be from Rice? Are you from the Baker group?
Well, actually, I'm a PhD student. You're right. It's funny. I was at something.
Do you know about the Baker?
I do.
What a cool place. Have you done anything?
Not really. I run into Amy Jeff.
Stuff here. She went to
Okay, I'm way behind the curve.
right now. The guy just
on, that's what got stuff. So I went to that, and
He's a great guy. He's been engineering from industry, so he has most of that. What do you know there beyond the deciding that
John Elder from Colorado State.
I'm trying to.
Well, he
And there were others.
So
And so that came up exactly your point. Somebody said, you know, you can miscount that
I
because
don't
if
know
you take
her
account that
personally.
this is, that's a lot of future production.
but it's your right. Look at for paper on the IOCs and IOCs. And then, but now it was a big deliberate. No, project.
Thank you. Yeah, someday maybe.
Okay, thank you. You're here in the city. Okay, okay, thanks.
There you go. I'm with you. You know, something
Like for your vacation.
and it's pretty much whomever did it on chart. I mean, I'm trying to think who made the point. Actually, he probably made that presentation in Washington. Almost. Do you mean at OIES? Oxford?
Assume not.
Do they use, I heard they use Oxford Same panel?
Yes, it's always on the conference is always on the same job. It's every 2 years.
Well, anyway, you just said, because at that point, I will, you know, I see, I've ever seen Charles is a pretty good, I mean, you definitely will. And I respect that. I mean, he's definitely an entrepreneur. And it was sort of interesting, just hearing him talk and stuff. He did mention that he got it from somebody else. I believe, I think that's I think it's so sometimes it's serendipitous. But I think it's really return of all the types of shale or the all these sometimes you're in the mix, but not as much. You guys are like really relevant stuff now. I think he's kind of deserving. I think it's kind of neat, you know. It's like because
I'm not sure if they have like a here
to get a little. I mean, it's we'll see what it becomes of
Thank you, Captain.
Good to see you.
Absolutely.